Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
3 things to expect from the January 2026 job report. This article was written by Chris Lau. Summary: January's non-farm payrolls likely showed modest job gains, supporting the Fed's view of a stabilizing 4.4% unemployment rate and steady policy rates. Healthcare hiring remained resilient, but investors should not extrapolate sector job trends to pharma or health plan stocks, as recent price moves reflect company-specific factors. Retail employment likely declined in January amid persistent inflation and post-holiday consumer spending weakness, with Amazon cutting 16,000 jobs attributed to AI-driven efficiencies. Markets rotated out of premium-priced growth stocks and into AI storage suppliers like STX, WDC, and SNDK, though the sustainability of this rally depends on realized corporate cost savings. Chris Lau, an economist, science major, and project management professional who leads DIY Value Investing. On February 6, 2026, the Bureau of Labor Statistics will report non-farm payrolls for January. In last month's release of November job data, investors had 5 things to consider. The ADP report suggested job cuts in November. More specifically, monthly jobs should have weakened due to job losses in telecom, media, and government, offset by an increase in retail hiring. Instead, the BLS posted an increase of 64,000 jobs in November. In early January, the BLS posted a 50,000 increase in employment in December. With 2 months of job increases in mind, offset by negative revisions, what should investors expect in January's job report? 1. Upcoming establishment survey data changes. To get the statistical details out of the way first, readers should be aware that the upcoming release of non-farm payroll employment, hours, and earnings data from the establishment survey will be revised to reflect the annual benchmark process and updated seasonal adjustment factors. The BLS might adjust non-seasonally adjusted data starting with April 2024. Additionally, its seasonally adjusted data begins with January 2021. This is standard practice that is consistent with the agency's past revisions in its benchmark process. The BLS will also adjust its birth-death model by using current data samples each month. Again, this is consistent with its past process, as explained here. The purpose of the Current Employment Statistics, CES, is to greatly improve estimates. Despite the BLS's efforts to report estimates as accurately as possible, news that the president would nominate a new BLS agency commissioner will overshadow the revision details. 2. December added 50,000 jobs. Employment increased by 50,000 in December, after food services and drinking places, plus 12,000, healthcare, plus 21,000, and social assistance, plus 17,000, trended higher. Likely partially hurt by tariffs, retail trade lost jobs, minus 25,000. Hospitals hired 16,000 positions, which helped to lift healthcare employment to an average of 34,000 monthly in 2025. This is below the monthly increase of 56,000 in 2024. Investors should not infer job trends in the healthcare sector to pick stocks in the drug manufacturer or health plan space. Merck, MRK, and Bristol-Myers Squibb, BMY, rebounded on their own merits. Pfizer PFE shares traded closer to a 52-week high, as investors bought the stock for its attractive value grade and its forward dividend yield of 6.51%. In Seeking Alpha's rating, PFE stock ranks 400 in its industry rank, and 14 out of 970 in the sector. In contrast, Regeneron REGN ranks 119 over 465 in its industry, but posted strong results, justifying its stock price recovery. Novo Nordisk NVO has an oral obesity drug that boosted its stock. REGN stock scores a D- on value and an F on growth. Still, all of the aforementioned companies score an A+ in profitability. Investors need to watch out for the dynamics in the Medicare sector. Last week, United Health UNH dropped by 18.6%. Markets discounted the stock after the Trump administration proposed reimbursement rates that UNH identified as disappointing. Elevance Health, ELV, CVS Health, CVS, Centene, CNC, Humana, HUM, and Molina, MOH, also dropped last week. Health Equity HQY rose slightly. In this peers tab, HQY stock has a quant buy rating. In the quant factor grade shown above, Centene scores well on valuation, profitability, momentum, and EPS revisions. Expect that healthcare jobs increased in January. Expected January job declines. Employment in retail trade potentially fell in the month. In December, producer price inflation increased by 0.5% month over month. The index for services increased by 0.7%, a rise not seen since July. Consumers continue to grapple with inflation, so expect their spending, net of price increases, to decline. Expect jobs in bricks and mortar and e-commerce to fall in the month. E-commerce giant Amazon, AMZN, cut 16,000 positions. Although it attributed the reduction to AI efficiency gains, retail sales likely weakened after the holidays. Note on December 2025 revisions. The agency revised the employment for October data down by 68,000, from minus 105,000 to minus 173,000. It revised the November data by minus 8,000, from plus 64,000 to plus 56,000. Taking an average revision of minus 38,000 from those reports, the BLS might revise December employment to plus 12,000, down from plus 50,000. Your takeaway. The U.S. economy likely added some jobs in January. That would justify the Federal Reserve's statement where it said that job gains remained low, but that the unemployment rate of 4.4% showed some signs of stabilization. That would keep the Fed funds rate at 3.5% to 3.75%. Ahead of the job report, stock markets adjusted their risk tolerance. They cut their position in companies likely trading at a premium and bought into companies demonstrating rising growth. For example, subscription growth in ServiceNow, and Salesforce, CRM, risks weakening, while storage for AI strengthened. That boosted shares of Seagate, STX, Western Digital, WDC, and SanDisk, SNDK, last week. The risk of investors pivoting into AI storage suppliers is that corporations fail to cut costs using the new Promise technology. That would hurt demand for data centers, causing the recent rally to fade. This article was written.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.